Welcome to The Bull and the Bear, a money and markets podcast. We give you the advice you need to know to make investing safe and profitable. With The Bull and the Bear podcast, you'll get exclusive access to some of the top thinkers, analysts, advisors, and gurus in the investment business. And now for your hosts, Matt Clark and Charles Sizemore. And welcome to an episode of The Bull and the Bear, a podcast by Money and Markets. I'm Matt Clark. Joining me remotely today. Hopefully that situation doesn't last. But Charles Sizemore is also with us. Charles, how are you today, man?
Doing all right. In there. How about you?
You know, I'm good. The weather here in South Florida is nice, a little humid, but can't beat it. I'm a kid from Kansas, so the heat doesn't bother me, neither does the humidity, because I'm kind of used to it. But no, things are good. I think we just jump right in, man. We've got a couple good things to talk about, kind of to preview ahead. I want to talk about unemployment. We had a story in Money Markets earlier this week about the unemployment benefits increase by Congress. One of our good friends, Mike Carr, who is a brilliant CMT, a chartered market technician, had some great things to say about that. And then I want to touch on something that you wrote for us, Charles, about dividend stocks. And I will say that your outcome I completely agree with, but I think it's good to present that information out to the listeners, and we'll talk more about that. But first off, I think the big news in terms of markets for this week, I mean, there's several big things out this week. You had unemployment figures that were, bad, but apparently not as bad as they could have been, which is good news. I don't know that 4.6 million new unemployed people on the rolls is necessarily good news, but Wall Street
it's all relative.
So. Apparently,
it's all relative. Yep.
Apparently, it was okay to Wall Street. Then you've got some first quarter earnings reports this week that weren't as bad as they were projected. Also, good news for Wall Street. Although again, I'm not really sure that only losing 3 cents per share earnings as opposed to the forecasted 7 cents per share is necessarily good news, because you're still losing, but Wall Street thought otherwise. I think the big market mover this week, or at least the one that had the biggest impact early, was oil. Oil prices, West Texas Intermediate crude oil, absolutely tanked on Monday, and it drove investors scurrying for safety, wanting to get well clear of equities. As I think at one point the May contract that expired on Thursday, I believe, had at one point reached, I want to say it was in the negative.
No, it was negative 40.
Negative 40, $50 a barrel.
I know.
And now don't be confused. If oil goes negative, that doesn't mean the gas station pays you to put gas in your car. You still got to pay for gas. It just means that it makes it a lot more difficult for oil producers, oil storers to turn any kind of a profit. And I had the opportunity to talk with Matt Battiali, who is a geologist and is also a solid investment guy for Banyan Hill Publishing. And he had some interesting takes on it. And I think I really didn't see it this way until he told me, but there's one thing, I'm sure there's multiple things, but one thing that's going to turn the oil market around, which we're already starting to see towards the end of this week, but there's one thing in particular that is going to put oil back on track and even push it higher. And I didn't even think about this, but shale. And I didn't, was something that I hadn't really kicked around until he explained it to me. And here's the rationale here. Right now, you have about, I think he said 7%, give or take, of the oil consumption now is based on shale. And when oil prices drop, because of clearly right now we have an issue with supply and demand, and there's just no place to put it. Cushing, Oklahoma, which is a huge storage depot, only has about 30 million barrels of capacity left to store, and we're getting that a day. So there's no place to put it, and this is why oil prices dropped the way they did, is because basically there's nowhere to go with it. It's still being produced. You can't shut off an
There's
oil
nowhere
well.
to go.
And oil producers are not going to shut off an oil well, because it is an absolute pain to start it back up, and you're going to wind up with probably less yield than you had before you shut it off. And oil producers don't want to do that. So you're stuck in this precarious situation where, you have to keep pumping, but you just don't have anywhere to put it. And the demand of it, because, we're all locked down, we're all, no one's driving nearly as much, and there's just no need for it. No one needs as much gas, or as much oil rather, as we do under normal circumstances. But here's what happens, though. You have these shale companies, which are highly speculative and extremely volatile. And when oil prices drop the way they are, you're going to see large players in the game. We're talking about ExxonMobil. We're talking about Chevron. We're talking about big oil players that are going to survive this no matter what, are going to tell these shale producers, we're good. We don't need it. We don't want it. It's not necessary. And then you're going to see these shale producers basically go out of business. And that's sad. That you don't want to see that. But in terms of,
it's already starting, by the way. Like this is not a hypothetical. Like this is already happening. Some of those shale producers there's already been some bankruptcies, and this isn't over.
and there's going to be more. There's going to be more of the seven. I think Matt had told me of the seven big shale producers, all of them are in debt. All of them are financially skittish, to say the least. And I think he expected all seven of them possibly to declare bankruptcy by year's end, if not even sooner. And you're right, Charles, we're already seeing that now. But here's where, again, they move away from shale, and they have to focus on just strict oil products that they're pulling themselves. Well, if you factor out shale, we're actually at and I can't remember the percentage, I want to say 30% to the downside in terms of supply and demand, meaning that because shale is such a large percentage of the oil consumption, when you factor that out, we're actually in a shortage. The problem is you've got to use what you've got before you can start bringing in that new oil supply, which, once the economy gets back up, whether it be, May, June, July, when people start getting back on the road, start being comfortable with what they're doing, we're going to see a turnaround. But I think the rationale, again, is you're going to see oil prices come back up. There's no question. They're not going to hover down. We're already seeing June futures tick up.
Well, they can't remain negative forever. I mean, that's absolutely certain. They can't remain negative forever. Back to the shale thing, though. One interesting aspect of that is a typical shale well has a very short useful life. These things tend to burn out's the wrong word, but they tend to get exhausted pretty quickly. I mean, the average life on these is just a couple of years. So it's one of those deals. If demand stays muted for a while, there just won't be any new drilling for a while. And, this glut gets worked off relatively quickly. It doesn't get worked off next week, of course. No. But it gets and months. And then also, you still have new oil. Less, of course, but you still have new oil coming down the pipelines. You have to use up all the new stuff that's being produced today, and you have to start working off these stockpiles of crude that are just filling to the brim every storage container in America. So this is months to clean up. Months and months.
Yeah, but for sure, if you're an investor and you're trying to think about, okay, is now a good time to invest in oil? Well, first off, there's a little bit different ways to go about investing in oil. It's not just, it's not like buying gold. You can't just buy gold and have it shipped to your house. So you have to be very cautious in terms of how you buy oil, what you do when you buy oil. Is it better to buy, maybe oil ETF, which coincidentally wasn't even tracking oil at one point and it was being bought into by a good number of new investors? Not a good idea. The bottom line, you have to do your homework for sure. But Charles, I'll ask you, if you are in the market to buy oil, whether that be as an ETF, whether that be as maybe you want to buy a REIT that handles oil platforms, or if you want to just buy oil futures, tell me what do you see as being the best option right now for an investor to go about if they wanted to invest in oil and maybe take advantage of what prices are now compared to what they could be in August, September?
Well, best thing to do, drain your swimming pool and get a really long hose and, all the way to Cushing, Oklahoma, and just fill it up with oil. Joking, of course. Your neighbors might frown on that. And even if your neighbors let them go. The FBI might look into what you were up to. Anyway, right. So you mentioned the ETFs. ETFs have been one of the worst ways to play this, partially because they're just poorly constructed. The largest and most liquid oil ETF got pretty well obliterated and actually exacerbated the problem in the market because this ETF was essentially doing nothing but buying the front month contract and then rolling it over. And so with oil in contango, and this is getting into sort of wonky, finance speak, but what that means in plain English is because they were just buying and rolling over the front month contract, they were perpetually buying high, buying the contract when it was out, and then as it would approach expiration, they were having to sell low. So in addition to the decline in the price of oil, they had a negative roll yield. They were just getting scalped every time they rolled this contract over.
It was vicious.
And so, and it was awful. But the thing is, this isn't even new. This has been going on for years, off and on, for not every month, but off and on for years. This security has been a nightmare to own because of this negative roll yield thing, this contango issue. And most investors just don't know enough about the nuts and bolts of the market to understand that. They think they're buying oil. They're not. It's not like the gold ETF, where the gold ETF literally has gold bricks in a vault somewhere backing it up.
Right.
This is futures, and it's not like there's just a bunch of barrels of oil sitting in some warehouse somewhere. It's not like that. These are futures, and they expire. And so, if you're going to go the ETF route, you need to know what you're looking at. And some of these ETFs, they're more balanced. There's one ETF that divides its portfolio across all 12 of the next 12 of the next month's futures contracts. So there's a little bit of the contango issue to deal with, but not that bad. So that's, if you're wanting to just play crude price appreciation, that is a route you can go. I would say, you're really better off probably not messing with the actual commodity itself. You're probably better off, if you want to play this game, buy some oil stocks. And there's several. You could buy the majors, the super majors. You could buy the Exxons and Chevrons of the world. Sure. You could also buy things that are not they're not directly tied to oil, but they seem to be tracking it. Natural gas pipeline companies, interestingly enough, have been beaten up almost as badly as crude oil, despite the fact that they're natural gas, not oil. We're actually burning off natural gas. We still use it in our homes for hot water and heating and everything else.
Right.
And the supply glut issue is not, there is a glut of sorts.
It's not nearly as bad as oil.
Oh, it's not as bad. And the prices aren't negative, for crying out loud.
Right.
So a lot of companies have been really beaten up, and I would argue unfairly. So I think there's definitely indirect ways to play it. That's the way I would do it. I would just steer the ETFs, honestly. They're just very badly constructed for the most part.
They are. And the thing you have to remember as an investor, whether you're new or seasoned or just kind of intermediate or hobby or whatever, is that you've got to do homework. You've got to do your research. You've got to know what you're getting into. Don't get into it just because you think it's the hot thing or you're going to make a quick buck, because honestly, it's not going to happen. 9 times out of 10, that's not what happens. It takes people years to build solid fortunes or enough to retire on or things like that. It's not a day trading thing. Oil is not a day trading type situation. So, personally, I would tell you to probably stay away from oil right now altogether. I know the price is advantageous. There's a lot of potential there. I just think there's still too much in question in terms of when do we get out of this economic slump? When do things get back to normal? And then how soon does the market try to rebound? And then more importantly is how soon can we, polish off this glut that we're in right now to where it makes oil profitable again? Because a $10 million barrel cut by OPEC Plus didn't really do anything. In fact, it did nothing at all.
Well, yeah, well, we were, when OPEC cuts back, that's great for world supply and demand, but it doesn't stop the immediate issue of there's just a ton of oil in the Permian Basin of Texas and elsewhere in the U.S. that's still being pumped. Whether you tighten up the prices elsewhere, you could have an imaginary where Brent crude goes to infinity dollars a share, a barrel. Brent crude goes to infinity dollars a barrel because there's high demand for oil, but you could have West Texas Intermediate at negative infinity because
Right.
there's too much in this one local market.
Yeah, there's too much out of
So
West Texas.
yeah, well, there's too much. There's too much locally and nowhere to put it. So
Right.
this is where like Warren Buffett says, it's when the tide goes out that you see who's been swimming naked. This is when the tide goes out here. You're seeing just when the financial markets just kind of quit working. This
Yeah.
is just this isn't how it's supposed to work. But the financial markets they're not magical. At the end of the day, they're supported by real world transactions, and right now it's all pretty gummed up.
Yeah. So recommendation wise, probably safe to stay away from oil ETFs. They're just not. I think Charles is right. They're just not constructed well. They're not going to provide you any type of gains. I know ETFs sound attractive because it's diversification, but if you want to play safe and invest in oil, natural gas is a possibility. Your super majors, which provide nice dividends, we'll talk about that a little bit later. Those are possibilities. My thought is stay away from it completely for right now. Just not a good idea to get into it. To jump to our next topic, this is a story that was probably in the making that nobody really realized, and that is, as part of the $2.2 trillion stimulus package passed by Congress last month and signed by President Trump, it did what was intended to be a benefit to people who were furloughed because of mass closures and things like that. It provided a $600 a week additional benefit for unemployment. And I believe in most instances, it extends unemployment out by a maximum of 39 weeks for states that have 26 weeks of unemployment, Florida not being one of those. Florida, surprisingly, only 12 weeks of unemployment and a maximum benefit of $240. Doesn't pay to be unemployed in Florida. However, other places it does. But what's happening here, and I think what people aren't understanding, is that while it is providing a nice benefit to those who are the millions who are unfortunately furloughed, and let's jump off by saying, let's not make light of the fact that there are millions of people out of work because of this coronavirus pandemic, and it's not feasible. We're going to see businesses go under. They're going to declare bankruptcy. We're already seeing big ones do that now. Retail stores, things of that like. But what the problem that it has created is that on the flip side, you've got businesses who are applying for and receiving the Paycheck Protection Program, which was initially a $350 billion plan to help small businesses keep their payrolls. And now there's about $310 billion added on top of that with the House vote yesterday and Trump signing it on Friday. But what has happened here is the $600 a week increase in unemployment has now made it more beneficial for people to stay unemployed and to not go back to work, because they're basically making more money being unemployed than they would be if they went back to work. And I don't want to be a naysayer and say that these people are, the people that are laid off and doing this are lazy or anything, because I don't think that's the case. I think if you really think about it, any smart person would do the math and think it makes more sense.
You do what you're incentivized to do. You do what you're incentivized to do.
Exactly.
That makes sense.
And if you're going to make more money, on a federal program, albeit temporary, it ends July 31st. But if you're going to make more money doing that as opposed to going back to work, and we're talking about, in some instances could be $200, $300, $400 a week, not a month, a week in difference in pay, then why would you not? Unemployment was meant, to me anyway, was meant to be something that at least carried you through until, from the time you lost your job not of your own doing, until you got a new job. And this process is not supposed to take an enormous amount of time. However, these are uncertain economic times. We are in a recession, but all that aside, this coronavirus pandemic, there's really no clear end. Georgia, South Carolina have talked about opening back up again on a limited basis, but still, millions of Americans are going to remain furloughed and unemployed. But the unintended consequence of what's happened here, of Congress's plan, is that now they are incentivizing people to not work. And it's putting people, business owners specifically, who have applied and have received the Paycheck Protection Plan money. It puts them in a huge disadvantage, because now they have to try to coerce their employees to come back. What do? They're between a rock and a hard place. So, again, I don't want to criticize, because again, there are people that are out of work that do need the financial assistance, and it is an issue. But I think this is going to cause a massive strain on businesses, regardless of whenever this economy opens, whether it be in 2 weeks or 2 months.
Yeah, that you bring up a real good point. And, let's say the businesses are, well, actually, there's so many different directions you can go with this. I mean, to start, it just the deals of the Paycheck Protection Plan is, the loan is forgivable if you use it to maintain payroll. Well, if you cannot maintain payroll because your employees have done the math and they said, look, boss, I'm sorry, but I got to do what's good for me, and this is hundreds of dollars more per week than I need, then you can't hire them back, which means all of a sudden those loans have to be repaid. Well, if I'm John Q. business owner, I'm going to think real hard about cashing the check. I mean, I guess I'll cash the check, sure, but yeah, that I'm probably not going to spend the money. I'm going to leave it there in the bank, so that if I need to just send it right back where it came, I will. I don't really know how this ends. And you also have to believe that. And by the way, like yourself, I'm not trying to be a naysayer. If you're in charge right now, if you're the government, this is a tough situation to be in, and there's no obvious answer. But I mean, this could actually prolong the amount of time it takes to recover from this. If the small businesses effectively can't get labor when they need it in order to keep some low level of operations now, because it's more advantageous to be on unemployment, yeah, then what do you do? I at this point, it's just stretching out the problem, making it even worse. So this is just where we're at right now.
Yeah, I think, Mike Carr, who's a chartered market analyst a chartered market technician rather with Banning Hill Publishing, great guy. This guy was in naval intelligence, by the way, in case you didn't know that. he had a naval career in naval intelligence, and now he's a huge options guy. He lectures for the New York School of Finance. Just a great guy to sit down and talk to. Very, very analytical, knows his stuff. And he called this the dumbest idea Congress has had in history. And I don't know that there's a lot of, I don't think that's necessarily overstating it. I really don't. I think that the intention was there. The intention was that we want to try to give a leg up to people who were unfortunately furloughed, not of their own doing. I mean, these people, it's not like, they're being furloughed because they're not good workers. It's because the market's just not, the market's closed. There's no one
because
shopping.
The door was closed.
Yeah.
The door of the shop got closed. Exactly. Yeah.
But what has happened here is that, because the amount is so much, I mean, $600 a week, that isn't cheap. I mean, that certainly is more than what most people make anyway, on top of, whatever you would get by your maximum benefit, by whatever state you live in anyway. So now they've just compounded the issue. So while the intention was probably okay, the consequence is going to be very bad for specifically small businesses. And I think, to your point about taking it longer, it's certainly going to take longer for these small businesses to open, because they can't afford to hire anyone. So they're going to have to wait till July 31st before they can hire anyone, because that'll be when people come off of their unemployment stimulus. So that just makes things worse. And I don't know what an answer is. I mean, I'm not a politician, never want to be, never will be. Covered politics, don't have any interest in being in it. I think maybe $600 might have been too much. I think, because again, if you take the average wage, that's pretty high. And I don't know if this was necessarily I think Republicans looked at it and thought, wait a minute, is this a typo? Did you mean $60 a week, or is it actually $600? And I don't know. I saw somewhere that this could be just kind of a backdoor play to increase the minimum wage.
You don't know what the incentive would be.
Yeah.
Well, maybe, but otherwise, you don't know what the incentive would be to pay somebody more. The whole idea of unemployment is to keep somebody afloat while they're out of a job.
It's a bridge.
It's a bridge. It should be equal to what they were making before, or maybe a little bit less. I mean, it's okay if it's a little bit less. Just again, this is a Band-Aid.
Right.
But the idea of it being more is just a very strange, very hard to explain phenomenon.
Yeah, $600 is way too much. I mean, 300 maybe, 200 maybe. I don't know, but I get it. And again, I'm not trying to suggest that we should be undercutting those who are unemployed through no fault of their own. I'm not, and I don't think, and Charles isn't either. I just think that the fact of the matter is that this is going to put a tremendous strain on small businesses specifically, because it is making it. It doesn't make any economical sense to try to go back to work if you're making more than you would be if you were working. And for small business owners, that puts huge pressure on you, because now how do you find work once the economy reopens? Once the doors reopen in Georgia, South Carolina, Florida, Texas, California, if you're a small business owner and most of your employees have told you, yeah, you know what, I don't really think I'm going to go back to work right now because it doesn't make any economic sense. What do you do? Where do you find your workforce? How do you open your doors back up when you don't have enough employees to staff? And it creates a huge problem, and it's something that I just don't think Congress really thought out in a rush to try to pass some kind of stimulus plan. But politics aside, one last thing before we get out of here.
Agree.
And Charles, you actually wrote this in Money and Markets, and I found it very interesting. And it was basically asking the question: is our dividend stock still worth owning? And I know, for me, when I present recommendations to the readers of Money and Markets, one of the first things I look for, or at least try to look for, are stocks that have, a relatively low beta compared to their 60-month beta is relatively low compared to what their industry average is. I try to look at, price to cash flow. Are they in good shape? If they have a dividend, because price to cash flow helps support that dividend and can actually increase it. But you raised an interesting question, and I guess I want to walk through real briefly. I would want to ask, what is a fundamental problem with dividend stocks?
Well, the biggest problem with dividend stocks right now is that they're paying less in dividends than they used to. Dividend cuts are really a problem right now. So a lot of stocks that have paid consistent dividend for years, maybe even decades, that does look a little bit questionable right now, particularly in some of the harder hit sectors like real estate. Real estate is one of the best, most consistent producers of income, but that's only when people actually pay their rent, and
Right.
That's a little bit dodgy right now. But that said, let's say you find a company that's paying a good dividend. You think it's highly likely that the dividend is going to continue to be paid in this environment. Not likely to be cut. If you think the market is going to be going sideways for a while, and I think that's not an unrealistic expectation. We had the market collapse on us, and then it roared back and made back about half the loss. But it's still down by, let's just call it 20% right now. It's changing by the hour, of course, but right now the market's still down roughly 20%. But remember, the market is already looking a little bit frothy long before it hit its recent highs.
Right.
We're basically back up to where we were, late last year.
Right.
And that's, that's a rather frothy stock market at a time when, corporate earnings are collapsing, and, we'll probably get some bankruptcies here. This is a dicey time. So with all that said, the dividend may be the only return you really get in a lot of your stocks for the next, several months. Maybe even a couple years. If this turns into a proper bear market. So, I did an analysis. I looked at a pipeline stock that I'd, followed for years and invested in, now and then. If you take the stock price back to all the way back to about 2010, the company's made no money in the last decade. Literally, the stock price
no share price growth at all
in a decade.
No share price growth.
No share price growth.
In fact, negative
in 10 years.
Yeah.
We'll just call it flat. Yeah, if you move it by a couple days either way, you can either get 0%, 1%, negative 1%, but let's just call it flat.
Right.
No growth in 10 years at a time when the S&P 500 has exploded higher. That looks really bad. However, when you take into account the value of reinvested dividends, if you had this on a dividend drip where you just bought new shares of the dividends, you would have been up about 120%. Now, 120% still trails what the S&P did. I'm not suggesting 120% is this just amazing, fantastic return over 10 years, because it's not. However, it's respectable. 120% over 10 years is a respectable return. So dividends matter. Dividends absolutely matter. In the case of this stock, I don't think we're naming tickers on this, which is fine. But in the case of this stock, again, absolutely no share price growth in a decade, yet investors that stuck with it would have enjoyed 120% return. That's not shabby.
No, it's not bad. But I think you actually raise a point, and we'll close out with this, and that is, don't just buy a stock based on its yield and think that it's going to get better or stay the same, because you never know. You have to do some research, and that's why, like I said, when I look at it, I look at what the price to cash flow is. I look at what their beta is, how volatile are they, before I say, okay, well, this has a nice dividend yield of 3-4%, whatever. There's a lot more factor in that. I mean, that dividend you look at initially, they paid in the first quarter of 2020 may look impressive, but guess what? That dividend in the second quarter, if it's there, it may not be where you think it is. So you've got to really look hard at what you're trying to invest in. So I think you bring up some good points.
You raise a good point as well. The other issue, and this is underappreciated, companies will do anything they reasonably can to defend their dividend. And the reason is it looks bad when you cut it. Like we cut the dividend, and investors go crazy. And so companies will pull out all the stops to maintain the dividend as long as they can.
That's right.
There is a problem. There is a problem with that, though, because if the company really can't afford the dividend, but it's focusing all of its financial power on keeping it anyway, that means it's taking cash flow away from perhaps other priorities that could put the company on better financial footing.
That's right.
Expansion into other industries, perhaps debt reduction, you name it. So companies, I get why they do everything. They pull out all the stops to keep the dividend. I mean, it's a reputational thing, and it matters. But you don't want to be, as an investor, you have a choice. You don't necessarily want to be in a stock that's just doing all it can to maintain a dividend it can't really afford. That's not good for the long-term health of the investment.
Yep. So again, bottom line here, as we've talked about with everything from oil to dividend stocks, do your homework. Check your work. Make sure that you know what you're getting into. Don't do it just because you think it is the hot thing to get into, because that is ultimately the wrong reason. And the other thing is don't risk any more than you're willing to lose, because there are no guarantees in life, and there certainly are no guarantees in the market. So if you're investing money, make sure you're willing to part ways with it, because it is a much higher probability that you will lose money than you will make it. And with today's uncertain economic conditions, it's probably more so. But Charles, it was good to have you on. We're going to do this again every week. I hope that you get get your travel things situated and get yourself on better footing. But it was great to have you this week. We'll do it again next week. You've been listening to The Bull and the Bear, a Money and Markets podcast. He is Charles Sizemore. I am Matt Clark. We'll talk again next week. Have a great week, everybody. You've been listening to The Bull and the Bear, a Money and Markets podcast. Tune in each week to hear insights on how to make investing safe and profitable for you.